Hello everyone, and welcome to this special report on the recent crash of U.S. Bank that many experts are calling worse than the 2008 financial crisis. In this video, we'll be taking an in-depth look at what led up to the crash, the impact it's having on the economy, and what steps are being taken to address the situation. Banking is the backbone of any economy, and the United States is no exception. But what happens when a bank breaks? The first thing to understand is that the USA bank crash is not caused by any one factor, but rather a combination of several key issues that had been brewing for several years, including lax lending standards, speculative investments in the housing market, and the use of complex financial instruments that obscured risk. Banks held toxic assets that were difficult to value and sell, leading to a cascade of their failures and a severe economic downturn. One of the primary drivers was a surge in subprime lending, which had been a major factor in the 2008 crisis as well. Banks had been making risky loans to people with poor credit, and as interest rates rose, many of these borrowers were unable to keep up with their payments, which led to a wave of defaults and foreclosures, and in turn led to a collapse in the housing market. Another major issue is the explosion of the derivatives market, which had grown to a staggering $1.2 quadrillion by 2022. Many of these were based on subprime mortgages, and as the market for loans began to crumble, so too did their value. This in turn caused a ripple effect throughout the financial system, as banks and other institutions that held these derivatives suddenly found themselves facing huge losses. Compounding these problems was the fact that U.S. banks had been engaging in risky behavior for years, including taking on large amounts of debt and making speculative investments. This left the bank in a vulnerable position when the housing market began to collapse, and as losses began to mount, the bank found itself unable to meet its obligations. One example is Silicon Valley Bank. The recent news about Silicon Valley Bank has sent shockwaves throughout the financial world, one of the largest banks in the United States, known for its focus on the technology and innovation sectors, but it seems that this focus may have led them down a risky path. Reports suggest that SVB invested heavily in illiquid funds. Illiquid funds are high-risk investments that are difficult to sell quickly, meaning that they tie up a lot of capital for long periods of time. SVB's heavy investment in these funds left them exposed with little liquidity to cover their obligations when the market turned against them. As a result, it is unable to meet its commitments, and this led to a run on the bank. Customers who were concerned about the bank's stability rushed to withdraw their funds, putting even more pressure on SVB's already stretched liquidity. But SVB is not alone in its investment practices. Many other banks have invested in trusts and bonds without proper liquidity, and they too may be subjected to similar pressures like SVB. This raises questions about the wider banking industry's investment practices and whether there needs to be a greater focus on risk management and liquidity. The events surrounding SVB have highlighted the need for financial institutions to be more cautious in their investment decisions. They must balance their desire for high returns with the need for proper risk management and liquidity. Failure to do so can have devastating consequences for both the bank and its customers. The impact of the SVB crisis will be felt for some time, and it remains to be seen what the wider implications will be for the banking industry as a whole. One thing is certain, however, the need for responsible investment practices has never been greater. According to recent reports, U.S. Bank had total assets of over $250 billion and was the 7th largest bank in the United States. The crash has resulted in losses of over $2 billion for the bank's investors and stakeholders. The crash has highlighted the need for stronger regulatory oversight of the banking industry to prevent future crashes. With the growing complexity of financial instruments, the impact of the U.S. bank crash has been severe, with many experts warning that it could trigger a full-blown recession. The recent crash caused a significant decline in the stock market, resulting in trillions of dollars in losses for investors, having a ripple effect across the economy, with many businesses struggling to stay afloat as consumer spending declines. This reduction in spending could lead to job losses and a decline in GDP growth, causing a recession. In addition to the impact on the stock market and consumer spending, the housing market has also taken a hit. Home prices have fallen sharply in many areas, causing homeowners to lose equity and making it harder for people to sell their homes. This could have a significant impact on the construction industry, which could lead to job losses and a decline in economic activity. Furthermore, it caused loss of people confidence in the financial system, leading to a contraction in credit and a decline in economic activity, leading to further decline in the stock market and a reduction in business investment. In response to the crisis, the Federal Reserve has taken a number of steps to try to stabilize the financial system. It has cut interest rates to near zero, injected trillions of dollars into the economy through quantitative easing, and launched a range of lending programs to support businesses and households. The government has also passed a number of stimulus packages, including direct payments to individuals and increased unemployment benefits. Despite these concerns, many experts believe that the banking industry will recover from the U.S. bank crash. They argue that the industry has gone through similar crises in the past and has emerged stronger as a result. However, it will take time for the industry to rebuild public trust and regain its footing. In the meantime, regulators and policymakers will need to take steps to prevent similar crashes from occurring in the future. They can learn from the 2008 financial crisis by implementing several measures to prevent future crises. The 2008 financial crisis showed the need for stronger regulations on the banking sector. U.S. banks can implement stricter regulations on risk management, capital requirements, and liquidity. Improved transparency in financial reporting can also help investors and regulators better understand the risks and potential vulnerabilities of financial institutions. Banks can learn from the 2008 financial crisis by diversifying their investments to reduce the risk of exposure to a single asset class or industry. They can improve their risk management strategies by investing in advanced risk modeling tools and training their employees on risk management practices. Banks can build up their capital buffers to absorb potential losses during economic downturns, reducing the likelihood of a crisis. Only by taking these steps, we can ensure that the banking industry remains stable and secure in the years to come. As we move forward, it's important to remember that this is not just a financial crisis, but a human one. Many individuals and families will be impacted by this event, and it's crucial that we come together as a society to support those who have been affected. We'll continue to monitor this situation closely and provide updates as more information becomes available. Thanks for watching. If you found this video helpful, please hit the like button and consider subscribing to our channel for more great content.